War always makes investors nervous, right? Missiles launch, markets drop, news channels start talking about economic uncertainty and everything else in between. And suddenly people start asking the same question amongst each other. That question is, should I sell my stocks? Or is this actually the moment you should be buying? Today, we're going to look at what war has historically done to the stock market and what investors should actually do when the world feels unstable, kind of like it does right now, right? Because the answer might actually surprise you. As always, though, quick disclaimer before we get started in the video. I'm just a random guy sitting here in his truck today. This video is for educational and entertainment purposes only. I'm sharing historical market behavior and how I personally think about investing during uncertainty and times like we're facing right now. This is not financial advice. Now, let's talk about what actually happens to markets during times of war. War creates uncertainty, and uncertainty is something that markets hate. When conflict breaks out, investors immediately start worrying about things like oil supply disruptions, inflation spikes, global trade issues, economic slowdown. All of those things can impact corporate earnings, right? So when war headlines hit, the first reaction is usually for people to panic. You'll often see markets drop very quickly in short term. But here's the interesting part about that, right? These drops historically don't last very long, even though a lot of people think they do or they're scared that they will. Because when you zoom out, the stock market has actually performed surprisingly well during many of the wars that we've faced in our country. Let's take a minute and look at history, right? During World War II, the stock market initially dropped, but within a few years, markets were rising again as the economy adjusted. During 1991, the Gulf War, right? Markets dipped briefly, but recovered within just a quick few months, actually. After 9/11, markets dropped sharply, but began recovering very shortly afterward. And even during recent geopolitical conflicts, like everything we have going on with Iran right now and in the Middle East, markets often react quickly in the short term, but stabilize faster than people tend to expect. Why? Because the stock market isn't pricing today, it's pricing the future. Markets don't react to the headlines like we react to headlines. They react to economic impact. For example, if a conflict causes oil prices to spike dramatically, like we're seeing right now, that can increase inflation. If trade routes are disrupted, like we're seeing right now, that can slow global commerce. If interest rates stay higher longer, that can impact borrowing cost. Those are things that investors watch very closely. Now, not just news headlines, right? And this is where long-term investors start thinking differently than others. Periods of uncertainty often create opportunity because when fear spreads through markets, prices sometimes drop faster than the fundamentals change. That's an important part to note right there. Long-term investors often see these moments differently. Instead of asking, should I sell? They ask, are assets temporarily cheaper, right? If your time horizon is decades, short-term volatility matters much less. In fact, some of the best long-term buying opportunities in history happened during periods of fear. Personally, I try to keep my strategy very simple, and I talk about it here on this channel. I invest consistently, every week, every month, regardless of what the headlines are saying. Because trying to predict global events is almost impossible. Instead, I focus on things that I can control. Those are things like consistent investing, long-term diversification, staying disciplined during volatility. History has repeatedly shown that investors who panic sell during uncertain times often miss the recovery afterwards. I don't want to miss that this year. The biggest lesson here is that markets are incredibly resilient. Wars end, right? Economies adapt. Businesses continue operating. Over long periods of time, markets have historically continued moving higher and higher. Now, that doesn't mean volatility won't happen. It absolutely will. But volatility and long-term growth can exist at the same time, and they often do. War headlines will always create fear in the market, but history shows something interesting. The biggest risk for long-term investors often isn't war. It's emotional decisions. The investors who succeed long-term are usually the ones who stayed disciplined during the entire cycle, even when the news cycle gets loud, and it's always going to. If you're interested in investing, financial independence, and building long-term wealth, subscribe to follow my journey. This channel that we have here documents my personal road to $1 million in early retirement before age 50. Also, comment below. Would you buy stocks during a market drop caused by global events? I would. Let me know.